Principal and Interest Payments Explained. This is Claudia and her son Alex. Claudia worked with the local real estate agent, and after months and months of looking, she and Alex found the perfect house. Everything was going really well until Claudia realized she did not have enough savings in the bank to be able to buy the house. Claudia's agent reminded her that most people do not pay cash up front for their homes. So like many others, Claudia could go talk to a bank about borrowing the money she needs to purchase the home. Claudia went online and made an appointment with a local mortgage banker. At the appointment, the banker informed Claudia that they would be willing to loan her the money she needed. However, she would have to pay back extra money to the bank. This extra money that the bank was going to charge is called interest, and Claudia would have to pay interest along with the amount she originally borrowed. The banker explained that the repayment plan would require Claudia to make monthly payments. Those payments would consist of the two types of money she owed: principal, the amount she received and used to buy the house, and interest, the amount of money the bank was charging for her to borrow the money. Claudia agreed to the repayment plan, but she had more questions for her banker. Exactly how much would her payments be? And how did the bank figure out how much she would need to pay back every month? After trying to explain using official terms and big words, the banker asked if he could explain how mortgage payments work using something Claudia was already familiar with: sales tax. Her banker promised that if Claudia understood how sales taxes were charged, she could easily understand how the amount of monthly principal and interest payments were determined. Sales taxes are based on a system in which taxes are due each time an item is purchased. Specifically, a dollar amount is owed to the government for every $1 spent. For example, Claudia lives in a county where the sales tax rate is 8 cents. So if Claudia bought something for $1, she would owe 8 cents in sales tax. If she bought something for $2, she would owe 16 cents in sales tax. If she bought something for $3, she would owe 24 cents in sales tax. And if she bought something for $3.50, she could easily calculate the amount of sales tax due. At 8 cents for every dollar and a sales price of $3.50, she would be paying 8 cents 3.5 times, giving her a total of 28 cents in sales tax due to the government. Claudia felt very comfortable with calculating sales taxes. Now her banker asked her to use a similar concept for establishing a monthly payment for the amount of money she would need to borrow to buy a house, otherwise known as a mortgage. The bank would calculate a monthly principal and interest payment amount, but instead of using a sales tax rate, the bank would use a rate of principal and interest that Claudia would owe for every $1,000 she needed to borrow. Let's start with the rate of principal and interest. For this example, it is $5.20. This means if somebody borrowed $1,000, they would owe $5.20 every month until they paid off all of the monies that they owe to the bank, both principal and interest. If somebody borrowed $2,000, they would owe $10.40 to be paid back every month until they paid off all of the principal and all of the interest owed to the bank. If somebody borrowed $5,000, they would owe $26 in monthly payments. But what would that mean if somebody were to borrow $150,000? We know that the payment consists of $5.20 monthly for every $1,000 borrowed. And in $150,000, there are 150,000, which means we will need to pay $5.20 150 times, creating a total of $780 in monthly payments until all of the principal and all of the interest has been paid to the bank. So what does that mean for Claudia? Claudia needs to borrow $375,000 to purchase her dream home. Based on the market's current interest rates and Claudia's credit score, they are willing to loan her the $375,000 to be paid back monthly in payments over 30 years. To calculate her monthly payment, the bank would use a factor, or rate of principal and interest, of $6.82. If she's borrowing $375,000, we can divide that amount by 1,000. This gives her a monthly principal and interest payment of $2,557.50. Luckily, Claudia has a great job and can afford this payment, but she still has another question. Where did her banker get the factor or rate of principal and interest from? In order to find a rate of principal and interest, a banker will utilize something called an amortization chart. This chart is full of rates that are actually dollar amounts. This is similar to how a sales tax rate is actually a dollar amount. To find the exact rate, the banker must refer to the terms of the loan. The banker told Claudia that if she borrowed $375,000, she would repay the amount in 30 years. And based off of Claudia's credit scores and FICO score, the bank would be charging her an annual interest rate of 7.25%. So using the chart, 30 years at 7.25%, Claudia's factor would be $6.82. Claudia would have to pay $6.82 for every $1,000 she wants to borrow. Her loan is $375,000, which consists of $375,000, so we multiply 6.82, or $6.82, 375 times, for a monthly payment of $2,557.50. What Claudia was explained about her loan payments is based on a financial concept called amortization. Amortization is a way to spread loan principal and interest payments over time, and in this case, as with many other mortgages, for 30 years, which made Claudia do a bit more thinking. Each month, she'd be paying $2,557.50. She would do this monthly, 12 times a year for 30 years. When you do the math, that means Claudia will be paying back to the bank a total of $920,700. Let's repeat that. Claudia will be repaying $920,700 in principal and interest to the bank. But her original balance, or the original amount that she borrowed, was only $375,000. The difference between the total she will have paid, $920,700 in 30 years, and the amount she actually borrowed to buy the house, $375,000, is $545,700. After 30 years, Claudia will have paid $545,700 in interest to the bank, almost double of what she originally borrowed. So, how does our story end? I guess it's not the happy ending Claudia dreamt of or that you wanted to hear, but it is the truth. That's Claudia and Alex's story, and I hoped it's helped you to better understand mortgage payments and explained how principal and interest payments work.